Most traders lose money not because they miss profitable setups, but because they take trades they should never have entered. The market reveals its true intentions only when the composite operator has completed his accumulation or distribution. Between these phases lies treacherous ground where even seasoned operators refuse to commit capital. Master traders don't just know when to act, they know precisely when not to act. For example, consider a stock consolidating after a sharp rally. Volume dries up, price action becomes erratic, and the spread between bars narrows considerably. The uninformed speculator sees this as a breakout opportunity. The professional recognizes this as no man's land, a period where the composite operator hasn't tipped his hand. He marks this congestion as a no-trade zone and waits patiently for definitive signs of either reaccumulation or distribution before risking a single dollar. Let me be perfectly clear about something I've observed over decades of studying tape action and market behavior. The market does not move randomly, nor does it accommodate the wishes of the uninformed public. It operates in three fundamental phases, and your success as a trader depends entirely upon your ability to distinguish between them. First, we have accumulation. This is the period when the composite operator, and by this I mean the large professional interests who have the capital and the strategic position to move markets, is quietly buying stock from discouraged holders. You'll recognize this phase by its characteristics. Prices have declined substantially, public interest has waned. Volume on rallies is light, while volume on reactions shows the absorption of selling. The trading range narrows. The stock appears dead to the casual observer, but to the trained eye, this is preparation for the next campaign. Second comes the markup or markdown phase. This is where the real money is made by those who position themselves correctly during accumulation. The composite operator has completed his buying. Now he needs a rising market to attract public participation so he can eventually sell his holdings at a profit. You'll see expanding price ranges, volume increasing on advances, and the public beginning to take notice. This is the trend phase, the phase where the prepared trader makes his campaign. Third, we enter distribution. Here the roles reverse. The composite operator who accumulated at lower prices now finds himself with a large line of stock to sell. He cannot simply dump this stock on the market without collapsing prices. So he must create the conditions for distribution, maintaining the appearance of strength while methodically selling into public buying. Prices may reach new highs, but watch the volume carefully. Notice how rallies produce less upward progress. Observe how reactions find support initially, creating the illusion of continued strength. Now here's what most traders fail to grasp. Between these clearly defined phases exist periods of uncertainty, of transition, of what I call no-trade zones. These are the dangerous grounds where even the composite operator himself has not yet committed to his next move. Perhaps accumulation is complete, but the markup campaign hasn't begun. Perhaps the operator is testing the waters, determining whether sufficient public interest exists to justify a new move. During these transitional periods, the market gives you conflicting signals. One day suggests strength, the next suggests weakness. Volume patterns become erratic. Price ranges narrow or whipsaw without conviction. The amateur sees opportunity in every wiggle. The professional sees exactly what it is, a market without direction, controlled by neither buyers nor sellers, a battleground where the outcome remains undecided. I cannot stress this enough. Your capital is your ammunition. Would a general commit his forces to battle when he cannot determine the enemy's position or intention? Of course not. Yet traders daily throw their money into these no-trade zones, hoping to catch the beginning of the next move. Hope has no place in professional trading. We trade on evidence, on the clear manifestation of supply and demand, on the demonstrable presence of the composite operator executing his campaign. Mark these zones on your charts. When price enters them, step aside. Watch, study, learn, but do not trade. Save your capital for those periods when all the elements align in your favor, when the market clearly shows which phase it has entered. That is when the professional operates, and that is when you should operate. If I could teach you only one principle from all my years of market experience, it would be this: price can lie, but volume reveals the truth. The composite operator can manipulate price with relatively modest effort, a few strategic orders, some well-timed buying or selling, and the uninformed public reacts predictably. But volume, my friend, volume tells you whether real money is behind the move, or whether you're witnessing mere manipulation designed to separate fools from their capital. Let me explain what I observe when a no-trade zone is forming. You'll see price movement, sometimes quite dramatic price movement, occurring on steadily decreasing volume. What does this tell the trained observer? It tells him that the smart money, the professional interests who move markets, are absent. They're standing aside. When the composite operator wants to move a stock, he must commit capital. Large capital. This shows up in volume. When you see prices gyrating without corresponding volume, you're watching amateurs trade with each other, pushed and pulled by their emotions, and by whatever manipulation the operator chooses to employ. Now consider the opposite scenario, equally revealing. You witness a sharp upward thrust accompanied by enormous volume, yet by the day's close, the stock has made little actual progress. The public sees that volume spike and thinks, activity, opportunity, I must participate. The professional sees something entirely different. He sees supply overwhelming demand. He sees the composite operator potentially distributing stock into public enthusiasm. That volume represents selling, not buying strength. The inability of price to advance despite such volume activity screams danger to anyone who knows how to read the tape. This is precisely the type of action you'll observe in no-trade zones. The market gives you conflicting signals between price behavior and volume patterns. One session shows an advance on good volume, perhaps the beginning of a markup. The next session shows a decline on equally strong volume. Or was that accumulation after all? Then several sessions of narrow range movement on diminishing activity. The picture remains incomplete, unclear, contradictory. I've watched countless traders ruin themselves by ignoring volume. They see a stock up 2 points and they buy, never asking whether that advance occurred on 100,000 shares or 10,000 shares. They see a decline and panic, never questioning whether the selling represented genuine distribution or merely a shakeout on light volume designed to scare out weak holders before the next advance. Here's what you must understand. The composite operator cannot disguise his footprints in the volume record. When he's accumulating, you'll see increased volume on declines as he absorbs selling. When he's marking up prices, you'll see expanding volume on advances as he allows the public to participate. When he's distributing, you'll see volume remaining high while price progress diminishes or reverses. But in the no-trade zone, volume becomes erratic, inconsistent, unreliable as a guide. This inconsistency itself constitutes your warning. When volume fails to confirm price movement, when the relationship between the two becomes muddled and contradictory, you're in dangerous territory. The professional operator recognizes this immediately and withdraws to the sidelines. I maintain extensive records of volume patterns for precisely this reason. I compare today's volume to yesterday's, this week's to last week's. I observe whether volume expands or contracts on advances versus declines. I note whether volume spikes produce corresponding price movement or peter out ineffectively. This study reveals the presence or absence of professional operation. Never commit your capital when volume tells you the professionals are absent or when volume patterns contradict price action. This discipline alone will save you from more losses than any other single rule I can give you. I want you to understand something fundamental about the nature of successful trading. This is a business, not a gambling enterprise, not a game, and certainly not a venue for emotional excitement. Like any business, trading requires capital to operate. Unlike most businesses, in trading your capital is constantly at risk. Every single dollar you commit to a position is a dollar that could be lost. Therefore, the preservation of capital stands as your first and most critical responsibility. The amateur believes his job is to trade. He opens his account, watches the ticker, and feels compelled to have a position at all times. If he's not in the market, he feels he's missing opportunity. He sees movement and wants to participate. This mindset is precisely what transfers money from the amateur's pocket into the professional's account. I cannot state this more clearly. Your job is not to trade constantly. Your job is to trade correctly, and correct trading means operating only when conditions favor success. Consider the mathematics of the situation. Suppose you maintain a trading capital of $10,000. You enter a no-trade zone, a period where the market gives unclear signals, where volume contradicts price, where the composite operator has not shown his hand. You take a position because you feel you must be active. The trade goes against you, as trades in unclear conditions often do. You lose $500, perhaps $1,000. That capital is gone, irretrievable. Now the market clarifies. The accumulation phase completes. The markup begins. All signals align. Volume confirms the move. Price structure shows strength. The composite operator reveals his campaign. This is the moment for decisive action, the moment when the probabilities stack heavily in your favor, but you no longer have that $500 or $1,000 to commit. You've squandered it in the no-trade zone, chasing ghosts and trading on hope rather than evidence. Do you see the tragedy here? You had the knowledge to recognize the high-probability setup. You understood what to look for, but you lacked the capital to act upon it because you dissipated your resources during the uncertain periods. This is how intelligent people lose money in the markets, not through ignorance of good setups, but through failure to preserve capital for those setups. I approach my trading account like a munitions depot. Each dollar represents a bullet. I don't fire bullets at shadows or uncertain targets. I wait until the enemy clearly exposes himself, until I can see exactly where to aim, until conditions maximize my chances of hitting the target. Then, and only then, do I commit my ammunition. This disciplined approach ensures I always have capital available for genuine opportunities. The market will present you with perhaps 20 or 30 truly outstanding opportunities each year, situations where everything aligns, where the risk-reward ratio heavily favors action, where the composite operator's intentions shine clearly through the price and volume structure. These are the campaigns that build fortunes. These are the moments that justify all the waiting, all the studying, all the discipline. But you can only capitalize on these moments if you have capital to deploy. Every dollar wasted in a no-trade zone is a dollar unavailable for these high-probability setups. Every unnecessary trade reduces your firepower for the necessary ones. I keep a ledger, and I track not only my trades, but my missed opportunities. When I review this ledger, I find something remarkable. My losses rarely come from the trades I take during clear market conditions. They come from the trades I take when I should have been sitting on my hands, watching and waiting. The preservation of capital during unclear periods is what allows me to act decisively during clear ones. Learn to sit quietly with cash when the market offers nothing clear. Your capital is not burning a hole in your pocket. It's gathering strength, waiting for the moment when deployment offers genuine advantage. Now I'm going to share something with you that took me years to fully comprehend. And once understood, it changed entirely how I approach these periods of market confusion. The no-trade zones you encounter are not accidental. They are not random periods of market indecision. They are deliberately engineered by the composite operator to serve his specific purposes. Once you grasp this truth, these confusing periods transform from frustrating mysteries into readable signposts of professional activity. Put yourself in the position of a large operator for a moment. You've studied a stock thoroughly. You've determined it's undervalued, that conditions favor a substantial advance. You're prepared to commit, let's say, $5 million to accumulate a position. But here's your problem. You cannot simply enter the market and buy $5 million worth of stock. The moment you begin buying aggressively, you drive the price against yourself. Every purchase pushes the stock higher, forcing you to pay progressively more for each additional share. By the time you've acquired your full position, you've pushed the price so high that little profit potential remains. So what does the intelligent operator do? He creates conditions that encourage others to sell to him at favorable prices. He needs time to accumulate without arousing public interest, time to absorb the available supply without betraying his intentions. He engineers a no-trade zone. Watch how this unfolds. The stock has declined substantially. The public is discouraged. Many holders are eager to sell and move on to better opportunities. The operator begins buying, but carefully, quietly. He allows the price to drift in a narrow range. Some days he supports the price to prevent a collapse that might trigger panic selling before he's ready. Other days he actively depresses the price to shake out weak holders and accumulate their shares cheaply. The result? A period of confusion, of narrow ranges, of apparent lifelessness that frustrates anyone watching. The amateur sees this action and thinks, nothing's happening here. I'll trade something more active, perfect. That's precisely what the operator wants for you to look elsewhere while he conducts his business, or worse. The amateur grows impatient, watching the narrow range, and attempts to trade the small fluctuations within it by the top of the range and selling the bottom exactly backward, providing liquidity for the operator's accumulation. The same principle applies during distribution, only in reverse. The operator now holds a large position acquired at lower prices. He needs to sell millions of dollars worth of stock, but he cannot simply dump it on the market without collapsing the price. So again, he needs time. He creates another no-trade zone. But this one occurs after an advance, often near what will prove to be the top. He allows the stock to rally to new highs, attracting public attention and buying. Then he sells into that enthusiasm. When selling pressure begins to show, he supports the price temporarily, creating the illusion that the advance will continue. He generates false breakouts, shaking out short sellers and drawing in more buyers, all while steadily liquidating his holdings. The price action becomes erratic, up sharply one day, down the next, sideways for a week. Volume increases, but price makes no real progress. This is distribution disguised as consolidation. The public trader sees this choppy action and thinks the market is deciding its next move. No. The market, by which I mean the composite operator, has already decided he's distributing. The confusion exists by design, to mask his selling until the process complete. Understanding this changes everything. When you recognize a no-trade zone, you're not witnessing market indecision. You're witnessing the composite operator at work, preparing his next campaign. These periods are not trading opportunities, they're observation opportunities. Study what's happening. Notice whether the zone occurs after a decline or after an advance. Observe whether the trading range drifts higher or lower over time. Watch volume patterns carefully. The operator must show his hand eventually. He cannot accumulate forever without marking up prices. He cannot distribute forever without letting the stock decline. But while he's working, while he's creating these zones of confusion, your job is simple. Stand aside and watch. Let him play his game. When he's finished, when he's ready to move, that's when you'll see clear signals for action. Here's where most traders fail, and I mean this quite literally. They make their most critical decisions at precisely the worst possible moment. They wait until the market is open, until prices are moving, until their emotions are engaged. And then they try to determine whether conditions favor action. This approach is backwards, dangerous, and almost guaranteed to produce poor results. Let me tell you how a professional operates. My trading day doesn't begin when the market opens at 10 o'clock. It begins the evening before, sometimes earlier. I spend my preparation time studying my charts with complete objectivity, free from the pressure of real-time price movement, free from the emotional pull of money being made or lost. This is when I make my most important decisions, not about what to buy or sell, but about where I will not trade. I mark my no-trade zones during this preparation period with the same care that a military commander marks minefields on his battle maps. These are danger areas, territories where I've predetermined that no action will be taken regardless of how tempting price movement might appear. I use colored pencils on my charts, red lines defining the boundaries of zones where I will remain inactive. Once marked, these boundaries are not suggestions, they are absolute rules. How do I identify these zones? I look for several telltale characteristics. First, areas where price structure provides no clear support or resistance ranges between significant Wyckoff events where the stock is simply wandering without purpose. Second, regions where previous campaigns have stalled without producing clear accumulation or distribution patterns. Third, consolidation areas too narrow to show convincing volume patterns, too brief to demonstrate genuine professional activity. These are the territories where even the composite operator hasn't committed his intentions. I also mark zones temporarily, not just on the price chart. If I observe that a stock tends to produce its clearest moves during the first hour and last hour of trading, I may designate the middle period as a no-trade zone for that particular stock. If I notice that certain days of the week produce erratic, unreliable movement, often Mondays and Fridays in my experience, I approach those entire sessions as potential no-trade periods. The critical element here is commitment made in advance. When you predetermine your no-trade zones during calm, objective analysis, you remove the single greatest enemy of successful trading: in the moment emotional decision-making. The market opens, prices begin moving, and you feel the pull to participate. But you glance at your chart and see that red boundary line. The decision has already been made. There's nothing to debate, nothing to reconsider. You're in a no-trade zone, and your predetermined course of action is to observe, not participate. I cannot overemphasize how this practice has protected my capital over the decades. I've watched countless traders, intelligent, educated people enter positions during obvious no-trade zones simply because they made no advance plan to avoid them. When real-time price movement engages your emotions, when you see others apparently making money, when you feel the fear of missing out, your judgment becomes clouded. Decisions made in this state rarely serve your interests. But when you've done your preparation, when you've marked your zones before emotional engagement occurs, the decision is already made. You're free to observe objectively. You can watch how the stock behaves within that zone, gathering information about whether accumulation or distribution might be occurring. You can study volume patterns without the pressure of having money at risk. You can wait for the stock to exit the no-trade zone and provide clear signals before you commit capital. This is professional trading, making decisions when you're calm and executing them when you're engaged. The amateur does the opposite. He waits until he's emotionally involved and tries to make rational decisions. It doesn't work. It has never worked. It will never work. Every Sunday evening I prepare for the coming week. I review my charts, mark my no-trade zones, and identify the conditions that would signal genuine opportunity. When Monday arrives, I don't ask myself whether I should trade. I simply execute the plan I've already created. This discipline, more than any technical skill or market knowledge, separates professionals from amateurs. Master this practice, and you'll save yourself years of costly lessons. Gentlemen, I've laid before you a complete framework for transforming your trading from speculation into professional operation. The no-trade zone rule is not merely a tactical suggestion. It represents a fundamental shift in how you understand the market and your role within it. Let me distill what we've covered into its essential truth. The market rewards patience and punishes impulsiveness. The composite operator, those large professional interests who move markets, operates on this principle constantly. He accumulates when others panic, distributes when others are greedy, and most importantly, he stands aside during periods of uncertainty. If you take nothing else from today's discussion, take this. Emulate the operator's discipline of selective action. You've learned that the market moves in 3 distinct phases, and that no trade zones exist between these phases. You understand now that volume reveals truth while price can deceive. You recognize that every dollar preserved during uncertain periods is ammunition available for high-probability opportunities. You grasp that no-trade zones are often deliberately engineered to serve professional purposes, and you know that marking these zones before the market opens removes emotional decision-making from your trading. But knowledge without application is worthless. I've given you the principles. Now you must develop the habits. Starting tonight, begin your preparation ritual. Study your charts. Mark your no-trade zones in red. Identify where the market shows clear professional activity and where it shows confusion. Make your plan before your emotions become engaged. Tomorrow, when the market opens, you'll face your first test. Prices will move. Opportunities, or what appear to be opportunities, will present themselves. Some will fall within your no-trade zones. When they do, you must do nothing. You must sit with your hands still, watching, learning, preserving your capital. This will feel uncomfortable at first. You'll feel you're missing something. You're not. You're learning the most valuable skill in trading, the discipline of inaction during unfavorable conditions. I promise you this, if you apply the no-trade zone rule with absolute consistency for 6 months, you will transform your results. You'll find that you take fewer trades, but the trades you do take perform better. You'll discover that your capital grows because you're not bleeding it away in low-probability situations. You'll notice that you sleep better because you're not holding positions taken during uncertain market conditions. The market has been operating on these principles for as long as markets have existed. They worked a century ago, they work today, and they'll work a century hence because they're based on unchanging elements of human nature and the mechanics of how large capital must necessarily operate. You stand now at a crossroads. One path continues what you've been doing, trading on impulse, responding to every price movement, wondering why consistent profits elude you. The other path requires discipline, preparation, and the courage to stand aside when others are active. Only one of these paths leads to professional success. I've shown you the way. The execution is yours. Begin tonight. Mark your zones. Make your plan. And tomorrow, when those zones are tested, prove to yourself that you possess the discipline to follow your own rules. Do this consistently, and you'll join the ranks of professional traders who understand that the secret to making money in markets is knowing when not to trade. The choice, as always, remains yours.